Hello everyone, my name is Kyle Nickerson and I am a wealth manager here with Rhame and Gorrell Wealth Management. Today we'll be covering a highly beneficial tax strategy available within the Baker Hughes 401k plan called the Mega Backdoor Roth. Now in this video we will be answering several questions involving what the Mega Backdoor Roth is, the specific mechanics surrounding this strategy, 401k contributions and tax features, the overall benefits of this strategy, and much, much more. If you or someone you know could benefit from this strategy or any of the other services that our firm offers, we invite you to contact our team for a complimentary consultation where we will review your financial situation to determine opportunities for optimization from an employer benefits, executive compensation, investment, tax, estate, and retirement planning perspective. So, what is the Mega Roth? Well, at its core, this strategy is a series of transactions that allows you to accumulate additional Roth dollars well beyond the IRS limits for direct Roth contributions. In order to fully understand the benefits of this strategy, I'd like to take a moment to refresh everyone's memory on how pre-tax versus Roth contributions work for tax purposes. As we may know, pre-tax contributions are made before taxes are paid. However, all of your contributions and your growth are taxed upon withdrawal in retirement. Roth contributions, on the other hand, are made after federal income taxes are paid, and all of your future growth and your original contributions are tax-free upon distribution. Some 401ks have a third account called the after-tax account. After-tax contributions are made with post-tax dollars, meaning you will not receive a tax deduction up front. However, any growth that takes place within this account is typically subject to ordinary income taxes. In a sense, the tax features of this after-tax account are the worst of both worlds. In 2024, employees can contribute up to $23,000 to their pre-tax or Roth accounts within their 401ks, with an additional $7,500 catch-up contribution if they're age 50 or older. This $23,000 limit is well below the IRS limit for all sources of contributions into the 401k, which for the year 2024 is $69,000. So, where can these excess contributions go? You guessed it, the after-tax account. So you might ask yourself, why would I contribute to an account with no current tax bill reduction and all of my growth will eventually be taxed as ordinary income? Well, it's because we don't leave the funds in the after-tax account to grow indefinitely. The Baker Hughes 401k allows employees to roll over their contributions from the after-tax account to a Roth IRA. Here's why this is beneficial. When you roll the after-tax dollars to a Roth IRA, the conversion is entirely tax-free. And your future growth in the Roth IRA is 100% tax-free as well. Additionally, Baker Hughes gives you the opportunity to roll any growth on the after-tax contributions in the 401k to a traditional IRA account. This helps minimize the impact of the pro rata rule, which would otherwise complicate Roth conversions if there was both after-tax contributions and taxable earnings in the same account. Let's take a look at an example to see how this works in practice. Imagine Sarah, a Baker Hughes employee who makes $200,000 per year, has maxed out her regular 401k contributions of $23,000. She also receives her company match of 9% or $18,000 in her case. Between her contributions and the company's contributions, she is putting in $41,000 $41,000 into her 401k. This $41,000 is well below the IRS limit of $69,000, so Sarah is able to make an after-tax contribution of $28,000. Sarah can then roll her after-tax contributions directly into a Roth IRA account, allowing her to take advantage of tax-free growth in the future. Meanwhile, if any growth occurs on those after-tax contributions before the conversion can take place, she can roll those growth dollars into a traditional IRA account where they will continue to grow tax-deferred, avoiding any immediate taxation. By following this strategy, Sarah maximizes her retirement savings and avoids the potential tax pitfalls of the pro rata rule. The Mega Backdoor Roth is a valuable tax savings tool for Baker Hughes employees. By rolling your after-tax 401k contributions into a Roth IRA, you unlock significant tax-free growth potential that would otherwise be unavailable. Over time, this can result in hundreds of thousands of dollars in tax savings. As always, we recommend discussing any potential rollovers or conversions with a tax specialist, such as the in-house CPA professionals on our team. We can help you understand the tax implications of these moves and ensure you're taking the best possible approach as it relates to your retirement plan. Thanks again for spending time with us today to learn about the Mega Backdoor Roth strategy as it applies to Baker Hughes employees. This strategy can provide significant tax-free growth potential and help maximize your retirement savings. At Rhame and Gorrell Wealth Management, we provide advice on roughly $1 billion in client portfolios. Our team of CFP and CPA professionals specialize in helping clients take advantage of advanced financial strategies to enhance their retirement planning. We invite you to schedule a complimentary consultation with our team by giving us a call, sending us an email, or by visiting our website today.